On Tuesday, President Bush and Treasury Secretary Henry Paulson announced that the government would inject up to $250 billion into the nation's banking system. This is part of the $700 billion program that the Congress just recently approved to help the financial system. At first, 9 large financial institutions will get money, banks like Citigroup, Wells Fargo, Goldman Sachs, Morgan Stanley, and so forth. Eventually, the money will also be distributed to smaller banks. The way to think about it is that a bank would use the $250 billion as capital, and they could borrow more money against that from the private market. So that $250 billion could essentially turn into $2.5 trillion of actual lending ability for the banks, because they usually are able to borrow 10 times as much as they have capital. This afternoon, credit markets look like they were improving a little bit, but investors and analysts said that the improvement so far has been very modest. The hope is that as this money becomes available to the banks and the banks start using it and putting it to work, that interest rates would come down for some of the kinds of loans that we've become used to having. The 30-year fixed rate mortgage loan in recent weeks has been around 6% or more. Conceivably, if this plan works as it's supposed to, those rates could come down. Those rates have been as low as 5.5% or 5% in recent years. Analysts said that the $250 billion injection should certainly help prevent a financial meltdown of the kinds we saw after Lehman Brothers declared bankruptcy in September. But they also note that it's unlikely to avert an economic recession. It's unlikely to prevent further job losses, and we'll certainly have more corporate failures in the next few months.